Welcome, everyone. In this particular episode, I am going to talk about assessing your home equity with low payments, all because of interest only. But the best part is, what could you do with this type of loan? So let's get started. I am Ebonie Beaco, mortgage strategist and senior loan officer with Home Loans Network. And today I want to talk about something that millions of homeowners are sitting on right now without even realizing how powerful it can be. And that is the equity in your home. So if you bought your home several years ago, there is a good chance you have built a significant amount of equity. For many homeowners, that equity actually represents tens of thousands and thousands of dollars, and sometimes even hundreds of thousands. And in most cases, even millions of dollars in wealth that's just sitting there, sitting inside your home. But the interesting thing, most homeowners know they have equity, but they don't really understand how to assess it strategically and even really what to do with it. And that is what I am here to talk about right now. Not just pulling money out of your home and you're looking crazy and you're like, okay, let me go buy some furs or let me go buy a new car. No, it's like way bigger than that. But here's the thing, understanding how to assess equity with low payments and have different options and interest only, guess what, is a very smart, strategic thing to do financially, but you have to understand it. Because when you understand how equity works, it can become one of the most powerful financial tools that is available to you. It can help you eliminate high interest debts. It can help you renovate your home. It can help you start up a business. It can help you invest in real estate, and now you are a real estate investor. Or it can just simply give you financial breathing power. Just be able to breathe. Take a deep breath. But the key is doing it the right way. And that is where many homeowners get stuck. Because the first place most people go when they want to assess their equity, they go to their bank. And guess what? Sometimes that's not going to work for you. And trust me, with the program that I'm going to talk about right now, you're not going to get it from your bank. At least not now. Because this is the first ever rolled out program like this. Now, here's the thing. When they walk into their bank and ask about a home equity line of credit, which is also known as a HELOC, and what they often hear is one or two things. Either they are approved for much less than what they expected, or they're either denied altogether. And here's the thing, it is really surprising to them because they know they got equity. Like they know that, hey, I bought this house below market value, or I've had this house for over years, or based upon how the market has changed, properties values in that area has increased. They know their value. That's the crazy part. But the bank says, kick rocks. That's what the bank told them. So why does this happen? Because see, most of the time it comes down to how traditional banks calculate the monthly payment when qualifying you for a HELOC. So traditional HELOC underwriting often assumes a much higher payment than what many homeowners are actually comfortable taking on. So even though the homeowner has plenty of equity, the debt to income ratio simply just doesn't work under the traditional guidelines with these big institutional banks. This actually happens all the time, especially when you have someone that is a self-employed homeowner, a commission income earner, retirees living on a fixed income, but yet remember, they bought that house 30 years ago. The house is paid off, or if it's not paid off, it's almost paid off. So they not worried about the DTI. They didn't already retired everything. But the problem is the bank says no. This also works for real estate professionals. And why I say real estate professionals? In two different ways. Because one, they're commission driven. Two, there's the other part of the real estate professionals that are real estate investors. So if you're a real estate investor and you have a property that has equity into it, this can work for you too. Business owners. Why does this program work great for business owners? Because again, if you have a property that has some equity in there, but you are a commission person, but you want to turn around and pull the equity out of that home so you can have capital for your business. So that way you're not taking out any business loans or merchant loans or equipment financing loans that is going to be substantially high in interest. This also works well with homeowners who just simply don't want to take on a large monthly payment obligation. Because see, I'm going to explain the difference between taking on a large payment monthly obligation. Because see, a HELOC, a home equity line of credit, is not a cash out refinance. That's the big difference. This is like a revolving line of credit, like a credit card. So this is exactly where different type of solutions can come into play when you have the right type of loan product. There's a program called Equity Select. And yes, I can help you get into this program. Not everyone can. Okay, let me explain. Equity Select, which is a home equity line of credit designed around something many homeowners value the most: payment flexibility. Now, when it comes to the payment being flexible, instead of forcing borrowers into a high qualifying payment, this program actually allows for much lower payment structures, including interest-only style options and capped payments. So let me explain what that means. That means that the homeowner can often assess significantly more equity while maintaining a manageable monthly income payment. Ain't that great? You can actually maintain a lower income payment for your mortgage. Bring and take that money and make it into income because you're smart. You could take that money to reinvest it. Let me give you an example so you can just really visualize how this looks, okay? So imagine a homeowner who applies for a $200,000 HELOC at a traditional bank. Because of the way the payment is calculated, the bank denies them. Now, not because they lack equity, but because the qualifying payment is simply too high for their income profile, which means their DTI is not in order. Now, that same homeowner explores a lower payment structure option. Suddenly, the number changes. Instead of qualifying for $200,000, they actually may qualify for $800,000 in available equity. And their starting payment could be as low as a few $100s per month for the $800,000 that's available in equity. Here's the thing. Let me explain something. The difference between that payment structure can make another example. So a homeowner can only support about $260 a month in additional debt based on their income. So maybe that was that retired couple who's on a fixed income, but back in the day, they both had well over six figures that they was making, but now they retired. So with a traditional HELOC, that payment might qualify them for $30,000 to $40,000. But with a flexible payment structure, that same payment could potentially support a $200,000 in available equity. So a traditional HELOC at a traditional bank may only qualify them for $30,000 to $40,000. But when you have a program like this particular program here, right? You are able to have a higher, be able to use most of your equity should you like to. Not most, but most compared to the traditional bank. All because you chose an Equity Select product. Now, I'm going to go ahead and tell you, when people hear that for the first time, it completely changes how they look at their home equity, because how the conversation shifts from I can access my equity to how can I use my equity strategically. And that's the conversation I love having with homeowners, Because see, the equity can be used in a lot of different smart ways. Some homeowners use it to consolidate high interest debt. Right now, there are millions of people carrying credit card balances at over 20%, and some even much higher than that. If you're a homeowner with a strong equity, replacing that kind of debt with a lower payment structure can dramatically not only improve your monthly cash flow, but it can improve your credit and make it even higher than what it currently is. Other homeowners use equity for renovations. Maybe you want to update your kitchen. Maybe you want to add another room. Maybe you want to improve the value of your property. Equity can be a powerful way to fund those improvements without touching your primary mortgage. Now, some homeowners use equity to start or grow a business. Entrepreneurs often need access to capital, but they want to keep their monthly obligations manageable while they're actually trying to grow their business. And then there are the homeowners who use their equity to invest in real estate. So imagine being able to leverage the equity in your primary residence to purchase an investment property or even a vacation home. And that vacation home, yes, it's your second home, but guess what? You could still potentially turn it into an Airbnb, because you're not staying there 365 days a year. So at least you could make some money every month, 2 days out the month. Guess what? You did that because of the HELOC. You was able to purchase that vacation home because you accessed equity out of your home with a low monthly payment due to it being interest only. Now, I have helped so many clients over the years understand how HELOCs works. In fact, I recently worked with a homeowner who owned a home in California that was worth about $1.5 million, and it was completely paid off. It was owned free and clear. They actually used an equity strategy to assess $500,000 and purchase a second home in Florida with an all cash offer. Their payment ended up being $1,500 a month for the money that they pulled out of their $1.5 million home. And now they own a whole nother property free and freaking clear because they paid $500,000 for it. And you know what? That monthly payment is $1,500. Tell me that's not crazy. That's the kind of flexibility that opened doors for people. Now, I also want to talk about something that homeowners sometimes often worry about, and that is the payment stability. Traditional HELOCs often have something called a recast. Now, what that means is that after a certain number of years, the payment can suddenly jump higher, much higher to be exact, because the loan converts into a fully amortized payment. That can create a payment shock. So imagine this couple paying $1,500 a month, and all of a sudden a few years later, that $1,500 a month for that $1.5 million home, $500,000 that they taken out, all of a sudden turns to $6,500 a month. You don't think that's a payment shock? Absolutely, especially if they go to a traditional institutional lender, because that's what's going to happen. But some of these newer structures allow for capped payments, meaning the borrower knows what's going on, how much their loan is going to be, what's the maximum that's going to be needed when it comes to their repayment, and how they need to pay every single month. And that payment stays capped for the full term. For many homeowners, that predictable knowing what your payment is and knowing what it's going to be, it actually provides a peace of mind. Like you're not chasing numbers. You're not trying to figure out, playing a cat and mouse games with numbers. Like, you know exactly what you're getting. So now what you do need to understand is this program is not designed for everyone. It's not a program that a lot of people is not going to understand. You need strong equity and decent credit. Typically around 650 is your credit score, or higher that it needs to be. Okay. But for homeowners who meet those criteria, the flexibility can be extremely powerful, especially if you've been told no by that traditional lender before. And this is where working with someone like me, a loan officer who understands strategy, who understands HELOCs, and who know what lender can do the right HELOC for you. Not just the loan programs, but know what HELOC is right for you. Because every HELOC option and every lender is not the same. Accessing your equity is not just about pulling cash out of your house. It's about asking the right questions. What are you trying to accomplish? Are you trying to reduce your monthly obligations? Are you trying to eliminate high interest debt? Are you trying to invest in something that creates additional income? Are you trying to create financial flexibility for the future? When you approach equity from that perspective, it becomes powerful. It doesn't become just a tool. It becomes something that you have created, which is your future, your longevity, your financial stability, your financial freedom. And that's exactly how I work with my homeowners. My role is to help you look at the numbers, look at the strategy, and determine whether you're assessing your equity that's actually there, or you're trying to pull something that's not there because you don't want to drain your bank. And when I say your bank, I don't mean the lender who's going to give you the HELOC. I mean your home is your bank. Your property is your asset. If nobody ever said that you didn't own a bank, understand when you got that house and you paid that house off, or you purchased it with cash and you did some rehab into it, and the market started changing to the point that you've gotten equity, that is your bank. So don't ever let nobody tell you you don't own a bank, because you do. Here's the thing. If you're a homeowner with equity and you have been wondering whether there is a smarter way to assess it, I would be happy to take a look at your scenario. You can always reach me directly at 312-392-0664 or visit homeloansnetwork.com to learn more. So understanding how this equity line of credit works is really powerful. Now, there are a few different states that the Select HELOC is in, but the ones that I represent right now is Florida and California. And I will tell you right now, many homeowners in Florida and California, they have built a significant amount of wealth just from their home equity alone. But when they apply for, like I said, their traditional HELOC, guess what? They're often approved for a much lesser amount than expected or simply denied. So the most common reason generally is the debt to income requirements. The traditional banks typically calculate the HELOC qualifications using higher monthly payments, which can actually limit how much equity you can actually get. But with this newer HELOC program called the Equity Select HELOC, it is helping so many California homeowners and Florida homeowners to qualify differently. This program offers flexible payment structures, including interest-only style payment options. So what that means is it allows the borrowers to assess more equity while maintaining manageable monthly payments. Here, let me tell you a few things that you can do that's perfect, right? If you're looking for debt consolidation, like I said, you're able to do that. If you're looking to improve your property, you're able to do that. If you want to start a business, you can do that. If you decide and you wake up and say, you know what, I want to be a real estate investor, guess what? You can do that. Because when it comes to this particular Equity Select program, this is based on, it's kind of based on age loan to value, right? And let me explain. Age does play a role in how much you may qualify for, which the payment plans are available. So to the older borrower, the borrower may have a payment option that becomes available, and the higher the eligible loan value may be. So for an example, I'm gonna give you a few examples, okay? So let's say you take someone that's 18 years old. The minimum age for the program is 18. That person can get a 5% payment plan that actually may be available to them. So 5%, okay? At age 55, because this program can go down as low as 1% interest only. That is how my couple was able to pull that $500,000 out and still make those low payments. If you take someone that's 55 years old, that's roughly around 3 to 4%. Someone that's 60 years old, 1 to 2%. At the age of 62 and up, the expanded debt to income guidelines come into play for different scenarios. So when I actually say this is an age-based loan-to-value product, that is exactly what I mean. Now, I also want to address something home borrowers often ask, and that is whether this is FHA or conventional loan. The best way to think about this is more of a non-QM style solution. It's not FHA. It is not a standard conventional loan. It is a unique equity assets product built to solve specific financing problems. And that problem is helping homeowners with equity who may not qualify under traditional mortgage or HELOC standards. And again, sometimes that traditional is not because of credit. It is because of the DTI. Let's talk about some of the practical ways that I'll give you an example of how not only a homeowner can use this, but let's say you take someone who wants to purchase a business, right? They can use this for business funding. So a self-employed borrower and entrepreneurs, they actually may want to use the equity strategically to support their business operations growth, but they also know that they need a much lower monthly payment. This is the powerful tool that you have when you're using the Equity Select HELOC. Now, I'm going to give you something that's even better than that. And I want to give you an example, okay? I'm going to give you actually a couple of examples. Let's say you have a borrower, right? And that client is looking for a $300,000 HELOC. This is a second lien example. They earn $7,500 a month. To keep their debt to income ratio at 50%, the maximum total monthly debt that they can carry is $3,750. Okay? They already have a $1,500 mortgage, about $7,000 in taxes and insurance, and around $600 in other monthly debt, such as a car loan and other obligations like their credit card payments. So that means before the new HELOC even enters the picture, they already have $2,800 per month in monthly obligations. So the maximum new HELOC payment can qualify for is only $950 a month. This is where the traditional HELOC fails. At a traditional bank, the qualifying payment for a $300,000 HELOC might be around $2,250, which is far above what this borrower can actually qualify for. Because remember, they already have $2,800 a month in monthly obligations, right? And they only bring it in this $3,750. That's all they bring it in. That's a problem. Because what's going to happen is that bank is going to tell you to kick rocks. They're going to say no. Well, there are some banks that's going to say yes, but for only something like $140,000 versus that $300,000 that they actually want, because that is all the debt to income ratio will support. But with this Equity Select program, that same borrower may qualify for a payment plan that brings this qualifying payment down to $950 $325 a month, which now fits within their borrower's debt to income ratio for a $300,000 HELOC. That means that they can access the full $300,000 that they actually wanted. And depending on the payment plan they choose, their actual monthly minimum payment may be even lower than the qualifying payment. That is why the program works so well for homeowners who are payment sensitive or income restrained, but equity strong. So if you're looking for a HELOC program that is payment sensitive or income constrained, but equity strong, the Equity Select HELOC is what you need. Let me give you another real example. I had a client who's looking for $495,000 in a HELOC, and they want to basically using this as a first lien option. The traditional financing solution that they were considering came with a payment of about $3,210, and their debt to income ratio was around 72%. So of course, quite naturally, they're not going to qualify because you're basically saying that they can't afford it. It's too high. But see, with this Equity Select program that I can do, this Equity Select HELOC, they were able to get a 2% payment plan. So a 2% interest only payment plan, which brought the payment down to around $1,000 a month for $495,000 with a capped qualifying payment of approximately $1,135. So again, the payment is capped at $1,135 for $495,000 versus them having to pay $3,210. That dropped their DTI from 72% down to 42%, which is in line where it needs to be. And it allowed them to qualify for the money that they needed. That is a significant difference, and that is how this works. So if you wanted to know more about this program, as I mentioned, please feel free to give me a call at 312-392-0664. I would love to be able to assist you with your mortgage options, your financing options, and overall your HELOC options. If you want to know how to access a home equity line of credit and use that money to not just pay off your debt, but to reinvest it and to grow a business or real estate investment, I am your girl. Send me a message and follow me on all social platforms.